Australian shares poised to plunge this morning after Swiss bank Credit Suisse found material weakness in its finances. Its shares nosedived more than 20%, and it's sparked new fears over the stability of the global financial system.
There has been reports of financial irregularities at the bank. Also, at the same time, we have seen outflows from customers. And then on top of that, its largest lender or its largest backer, the Saudi National Bank, has come out and said it won't provide any financing or liquidity for the bank because of regulatory concerns.
Over the weekend, US lender Silicon Valley Bank and Signature Bank collapsed, leading to a US government bailout. Let's get some more on this now. Joining us is the Chief Investment Officer at the Motley Fool. We love you here, Scott Phillips. So much we have you twice this week. Just first of all, this is troubling. What's your thoughts on this?
Wasn't it? The shares fell 24% at one point overnight. I don't know what the final share price was, but falling meaningfully because investors are worried that Credit Suisse will no longer be able to pay its bills. The good news is the Swiss National Bank has agreed to give Credit Suisse liquidity. We know when it comes to bank runs, we spoke about this on Tuesday, Here we are again. When you think about bank runs, it is liquidity that really brings these institutions undone. If they have the cash, if they have the liquidity to make sure they can meet their obligations, that is going to slow down any potential domino from this one. But it does seem like there is material problems here. I wonder whether Credit Suisse will survive this one in its current form. Again, remembering, of course, Silicon Valley Bank won't survive either, but the depositors and the borrowers will simply, have their assets and liabilities transferred to another bank. So how badly this goes, the big risk is the international contagion from Credit Suisse. Silicon Valley Bank, 18th largest US bank. I mean, that's big in absolute terms, but pretty small in relative terms. Credit Suisse particularly, this is a massive, massive multinational bank. The real risk, things like derivative contracts, the IOUs that go around the financial system. This is what we dealt with in 2007, 8 and 9. That's the big one here, is what obligations does it have to other banks, other institutions around the world outside just a single country's borders?
Yeah, I mean, see, I didn't know until a few days ago what Silicon Valley Bank was. I didn't know Signature Bank.
Right.
I know Credit Suisse. A lot of people know Credit Suisse because it's integrated into the global financial system, right? So this is a bigger deal.
Massive. And again, particularly if it collapses in a bad way, again, if they can wind it down, we're fine. It's the question of what if it all comes to a head very quickly in a way that can't be dealt with. During the GFC, we saw a credit freeze right around the world. Banks right around the world stopped dealing with each other because they didn't know whether they could trust not necessarily the bank they were dealing with, but who that bank was dealing with. It's your counterparties that you need to worry about. So that's the real challenge when it comes to the big banks and the international. The Credit Suisse is one of the biggest international banks that is dealing, and again, not so much in its absolute size. There are bigger banks in the US, but the fact it is a multinational bank, the fact it is, particularly in Europe, which is still struggling. I mean, that really has never got its head above water post-GFC. 15 years, effectively a lost decade and a half there. So the impact of this, if it's allowed to fall out, could be massive. I think we should assume, at least in the short term, regulators will find a way to cover this one. But at some point, if it gets away from them, if it's too big, too complex, just simply too much money involved, then we do have to worry about the dominoes that fall from here.
But, I mean, that's right. Yeah, the domino effect. There is a trend here that's starting to emerge, right? You've also got here, right, the largest investor, Saudi National Bank. It's not chipping anymore. It's decided not to chip any more money in to help it out. I mean, how much do you read into that?
At the end of the day, you've got investors who are only looking at their own back pockets, and fair enough too. You've got then the national banks, the central banks around the world, making sure that the system itself isn't a problem. So two very, very different entities here. One trying to maximize their cash and, frankly, avoid losing any more. Remember, the share price is down 24%. It was already at a record low yesterday, fallen another 25% today. So they're bleeding more and more and more cash. I don't blame an investor for saying, hey, I'm not going to stump up more what might be a lost cause. Remembering, of course, Silicon Valley Bank shareholders completely wiped out. So you have got these kind of misaligned incentives here where, as an investor, as a shareholder, you face the risk of losing absolutely everything.
Yeah.
The national banks, the central banks, got to try and keep this alive.
I mean, conversely, you might think that if the Saudi National Bank thought, well, okay, we've dropped 24% here, we could get some more shares at a cheaper price, but it's still not willing to do that.
Correct, and I think that's exactly right, and for the right reasons. And I think you mentioned Silicon Valley Bank on Tuesday. Here we are with Credit Suisse on Thursday. That's exactly why they're not, because they've looked over there and said, hang on, maybe I get shares cheaper. But if this goes to zero and I can't see inside the bank well enough, you started the story talking about the financial reporting issues that the company's got. So if you're an outside investor, you're saying, well, how much do I trust about the numbers? How likely am I to get my money back? And if you don't know, good money after bad kind of comes to mind. You're not going to throw more cash in where there's a potential problem.
So can you explain that for me, Scott? So so Credit Suisse has acknowledged that it found material weaknesses in its financial reporting. So just simply for our audience, what does material weakness mean?
So we don't know is the short answer, Pete. The slightly longer answer is a bank is obliged to understand what it owes and what it owns and be able to put those together and understand its financial position. There are really sophisticated operations inside these banks that make sure that what it owes and what it owns are roughly matched off in terms of the cost, in terms of the duration when these things come due. Now, we don't know what those irregularities are. The big risk, and I think why the markets are worried, think about derivatives contracts, for example, the obligations you may have if certain things come to pass, whether or not those are currently profitable or unprofitable trades. There's so much of this which relies on estimates. Remember mark-to-market accounting during the GFC, the idea of if you own an asset, take a house, for example, right? If house prices halve, you've got to write down that value. If they double, you write up that value. Mark-to-market means what is it currently worth in the market? Now, if you've said, I'm going to close my eyes, block my ears, and pretend this asset's not worth any less, you can show a great number on your assets on side of the balance sheet. If someone uncovers the fact, and again, I'm not making allegations, this is an example, but if you realize, hang on, we've been overstating that asset value because of either someone's after a bonus or someone's trying to make things look better or whatever else it is, if it's been materially overstated and that overstatement brings down the assets, you have a mismatch, an imbalance between the assets and the liabilities, and all of a sudden you're in a much, much weaker position. So that's an example of what might come to pass. We don't know, so I don't want to speculate too wildly on what actually is happening. But as an example, that's the sort of thing that investors will be worried about right now when they say, hang on, do I really own what I think I own? Is Credit Suisse as strong as I think it is? Does it really have the asset backing that it says it does? And again, in the context of Tuesday's news or over the weekend of Silicon Valley Bank collapsing, when it's fresh in everybody's minds, everyone's already on a hair trigger. You hear financial reporting irregularities, misstatements, and you start to think, oops, this could get ugly. I better be careful. Again, we talk about the idea of a bank run being started by those fears, and that's why confidence is such an important thing. The Swiss National Bank coming to the party, backstopping liquidity is a very good thing for the financial system. But how long, how much, how well it can do that if these multinational obligations are a problem, I'm not sure the Swiss National Bank can come to the party. Now, maybe we end up with a cohort of global central banks or regulators finding a solution. But this is a pretty serious potential issue that the regulators are going to have to deal with over the next 48 hours.
Scott Phillips, appreciate that. Thanks for explaining. See you again next week.
Thanks, Pete. Time, mate.